Hi and Happy New Year. I'm Andy Parker from the investment team here at Vestia. Before I jump into a market update, I just wanted to touch briefly on some of the events we've seen in our country over the past month. We've heard strong opinions from our doctors, resulting in a wide range of very understandable emotions. And while at Vestia, we certainly understand the broader significance of these events, from an investment perspective, we're going to do what we've always done, and that's continue to focus on the things that we can control and focus on the things that studies and research have proven over time to add value to portfolios. Keep that in mind as I recap 2020, and I also answer some frequently asked questions that we saw at various points throughout the year. 2020 included a global pandemic, social unrest, economic disruption, and an election. It was a wild year, as you already know, and I think the best way for me to characterize it is that this was a year of diverging outcomes. We saw that economically as some people lost jobs or had income reduced, and other sectors of our business and other sectors of our economy boomed. We saw that in the disease itself, as those who were infected had varied outcomes. Our financial markets were no different. On this table, we're giving you performance information for the first half, second half, and full year data on 2020. We look at four of our most broad-based asset classes. As you can see in the first part of the year, it was those large companies in the United States that were best positioned to weather some of the economic disruption that COVID caused. A patient and disciplined investor was rewarded in the second half of the year as small companies in the United States, and especially emerging market companies, did really, really well. You can see that by the end of the year, if we look at full year data, they caught up to those large companies in the United States. This led to our first very popular question coming right in the second half is, why wouldn't we just allocate more of our portfolios to these big companies in the United States? It's names we're familiar with, companies we're comfortable with. Why wouldn't we just look at allocating more of our portfolio that way? To answer that, and again, we wish we had the crystal ball. It'd be really, really nice to be able to be in the right segments of the economy when they're doing well and out of the ones that are doing poorly. I wish we knew that. Studies and research don't suggest that that's possible. And to answer the question, we just look at historical data. And I'll give you a few different time periods where that diversification really paid off. The first one, as you can see on this chart, is the year, starting in 2000 to the end of 2009, the 10-year period, where the S&P 500, which has done really well in the recent past, in this 10-year period happened to lose money. In general, an investor who put their money in the S&P 500 would have had a dollar turn into 91 cents. Contrast that with a globally diversified balanced portfolio, similar to our 100% equity models, and that person's dollar would have doubled. I'll use another example from 1966 to 1982. If we were invested in the S&P 500, the S&P 500 in general would have done worse than the T-bill, and the T-bill is the place that investors go when they're not looking for returns or high returns, and they're just looking for safety. That's an entire 16-year period where just being in one of the safest asset classes would have yielded a better return than something like the S&P 500. And so this isn't to pick on S&P or any one segment of our portfolios. We believe all of them are very important. And this just shows why that diversification really does matter to your portfolios. The next common question we saw came in the second half of the year as we started to hit new all-time highs. There was concern from some investors that because we hit those all-time highs, it may not be a good time to be in the market because of a potential correction. It's our philosophy not to time the market. And again, we use history as our guide just to look at this claim. If we look back on almost 100 years worth of data, the S&P 500 going back to 1926, and we look at every time the S&P 500 hit a new market high with the 1, 3, and 5 year periods that follow, there's no evidence to suggest that we should stray from that philosophy of not timing the market. In general, we're really, really close to long-term market averages, especially in that 3 to 5 year range. And then in the 1 year range, on average, we've been above that long-term historical average. So we feel really good about sticking to that philosophy of not timing the market. And finally, with 2020 being an election year, you can imagine we had some questions related to that. Most recently, with the news out of Georgia that the Democratic Party would control the House, Senate, and White House, there was concern that this might be a bad thing for the markets. Again, popular theme here. We're going to look back historically to see how that might have affected the markets. Ironically enough, in the 13 years that the Republicans have had this unified government control, and then the 34 years that the Democrats have had this unified government control, the returns in the market were exactly the same. I don't know how that's possible, but it's true. At 14.52%, we saw identical results in either of those scenarios. So while we understand there's going to be varied opinions, and usually we have preference that the party we voted for is in power, there's no history to suggest that we need to make changes to your portfolio just because we see this. So as I mentioned earlier, with so much outside of our control, we continue to focus on just the key aspects that studies and research have proven over time to add value to your portfolio. That's maintaining proper diversification, staying disciplined during market volatility, managing for the best tax efficiency, and then reducing your overall expenses. If we continue to focus on these items, we give ourselves the best opportunity and the best probability of hitting those desired outcomes and goals as you define them with your advisor. So as we say goodbye to 2020 and we look ahead towards 2021, we remain very confident in the long-term outcomes for your portfolios. How can we say this? I think we can say this because we've seen pandemics and wars and depressions in the past, and we always bounce back. We bounce back because humankind is resilient and we're innovative. And that innovation leads to new products that get produced by companies, and we as consumers purchase those products. When we purchase those products, it leads to profits for companies, higher profits for companies, and that's ultimately the driver for long-term stock market growth. It's this chain of events that gives us that long-term confidence in the outcomes for your portfolio. So I don't always know how, I don't know what that innovation looks like, and I don't know the pace, but I do know we can count on the human race for progress because of that collective knowledge, wisdom, and fight we possess. Happy New Year, everybody. We wish you all the absolute best.